All right, let me know if you can hear me in the chats. Let me know how your guys' days is going so far. We still have an hour left of RTH, and I feel like this last hour of RTH is going to be pivotal for what can happen throughout the rest of the week. So let me know, are you guys doing all right today? Let me know how your trading day went. What did you trade today? Commodities, futures, bonds, stocks, crypto. What did you do? Up nicely. Great day. Great job, JP. Yeah, for me, I'm definitely going to do a deep dive on what I did today. And we're going to do a deep dive on what's going to happen for me in the next coming days, or what I want to happen in the next coming days. Shorted all-time highs of futures. Yeah, that's what I did as well today. But I'm going to explain my execution parameters because it's very important to understand why I shorted today. This is the first time I shorted the market. And honestly, I cannot tell you the last. Oh, I do remember the last time I shorted the market. It was somewhere here, probably. Actually, I think I shorted NQ. Let's go back here. Yeah, honestly, I don't remember the last time I shorted, but anyways, I did short today, but it was a hedge. The short that I executed today was not a traditional trade. It is a hedge. A hedge is very important to understand, and a hedge is something that we've been doing for multiple years now in trading wars. As you know, our portfolios are always extremely green because we invest in the S&P and we invest in the Magnificent Seven. So you should be extremely green in your portfolio, such that hedging yourself in specific situations like today makes a lot of sense. But the only reason why I was able to short, or why I wanted to hedge today, was given the market context and market structures, obviously. So we're going to go into a deep dive in the pre-market notes. If anybody else has anything else they want to comment on before we jump into the analysis and the review, definitely let me know. And other than that, obviously we still have an hour left of RTH. That's going to mean a lot. It's going to mean a lot where we close. Do we close above or below the prior day's low? Do we sustain this false breakdown? Do we short squeeze already above 67.30? There's a lot of questions that need to be answered. So let's go ahead and jump into the notes for today. So before we talk about the notes, understand that when we're entering futures positions, or really any position, we want to look for an edge. And our edge, the most basic and consistent edge that we use is the false breakdown. It's called liquidity sweeps. It's called turtle soup. It's called a bunch of different things nowadays. But if you're going to read a classic technical analysis trading book, they're going to call it false breakdowns. That's the original terminology for the edge. And the edge is in essentially the market's collecting stop losses at significance inflection points, significance lows, and it's tricking short chasers into believing that the market is going to crash because, as we know, sellers always take the elevator trip down the range. Of course, there's going to be specific situations where false breakdowns fail, but nonetheless, that's going to give us the quality entries for us to take advantage of. And one of the greatest quotes in stock market history is, you want to place your entry where everybody else's stop losses are placed. So without further ado, let's go ahead and jump into the notes. So the insane parabolic trend continues. We have some timing catalyst today during RTH. Let's see if it sparks volatility. Bulls are working on a fresh all-time high breakout structure from yesterday's surprise trend day higher. Important for them to hold it today. If not, maybe we can get our first taste of volatility. So in the pre-market live stream today, we talked about the significance of the external context for today. Specifically, everybody's best friend is Mr. Jerome Powell, and he was on the podium today. So his speech around lunchtime, his announcement around lunchtime, whatever he wanted to say around lunchtime, that could have an impact on the economic, on the chart, right? It can have an impact on buyers and sellers. The emotional perspective of what's happening in real time based on the external context was important. And based on the internal context, yesterday, buyers were able to supplement a massive trend day above the previous all-time high. So that creates fresh breakout structure. If it fails today, anybody that's buying the breakout is trapped, and that creates a false breakout pattern in which is bearish, right? So yesterday we broke out above last Friday's high, which was all-time high. price held above it and continued higher. This is the new all-time high breakout structure, 67.3150. 61.3750 is a must-hold level if buyers want to stay in absolute control. On the downside, sellers must break down 67.3150 for this fresh all-time high breakout structure to conclude and for bullish timeframe alignment to conclude. If there is volatility today via our friend Mr. Jerome Powell during the scheduled economic reports, 67.3150 is the first level that must break down. Below there, we have 67.1975, which is also an important breakout level from yesterday. If this zone is to break, let's see if the market can enter liquidation mode, which is a principle of ES. It has been nothing but upside for the entire month of September, so be cautious if we do enter a liquidation event, and apply the entry models to set yourself up for success. So this paragraph is extremely important, and this paragraph is why this is high quality analysis for ES. If 67.1975 through 67.3150 is to fail, bulls must print a false breakdown of yesterday's low, 67.0575. This is a significant inflection point on the chart for this week so far, as it started the breakout trend above all-time high. So yesterday's low, the opening drive higher from yesterday's opening range in the morning, is what created the breakout structure. So bulls must hold it or the entire structure comes collapsing down. The failure of yesterday's low can collapse the whole structure with too many trapped at the highs, in which last Friday plus Thursday's lows must hold. Buyers today simply want to defend above the fresh all-time high structure, 67.19 through 67.31, to retain absolute control and create a range day within the balanced highs. Be aware of volatility during the news events. So the main takeaway for today is 67.3150. It's the fresh all-time high breakout structure. Another main takeaway is Jerome Powell on the podium. That's external context that you have to be aware of if volatility is to increase. But if volatility is to increase, which means volume has to increase, then 67.3150 is your line in the sand. Below there, volatility is high. Above there, volatility is low. That's why it's the line in the sand. So 67.3150 is right here. And off of the open, we were defending below all-time high. So the fact that all-time high didn't break out again at 67.56 showcases that there isn't continued bullish time frame alignment. And then we got confirmation that there isn't continued bullish time frame alignment because 67.44 broke down, and more importantly, 67.3150 broke down as well. So when I was reading the watch list today, and when I knew that we were essentially trending for multiple days at this point with fresh breakout after fresh breakout, I want to hedge myself. I know that the chart is not going to go up forever. So what I literally did is I shorted right below all-time high when I saw that all-time high was holding 67.50.20, and I placed a 20-point wide stop loss for my hedge because I want to stay hedged as long as possible, in which right now the trade is at a little bit more than 2R. But since it's a hedge, I'm literally just holding this short until my macro low of interest gets activated. So if you guys understand why I shorted today, definitely let me know. If you're confused on what I mean by a hedge, let me know as well. I have massive green tickers in my portfolio with UNH and Tesla and things like that. So I want to hedge those positions, right? And you can use futures as leverage to hedge yourself, or you can use options as well, right? There's no wrong answer. Hedging is a traditional and it's a very classic trading strategy, right? Other than that, let's talk about the false breakdown now. So back in the notes, we talked about 67.0575 being a significant inflection point on the chart. And if buyers are to sustain somewhat control, then that must hold. We must see a false breakdown below 67.3150. Now we have to talk about the entry models. So the best thing about today's false breakdown at the prior day's low is that all three entry models were available. Doesn't matter which one you chose to do, all three of them worked for at least a scale target. So nobody should be losing a full position on the false breakdown of the prior day's low. Before we get into it here, the prior day's low is not a level that I am going to trade because it is still an intraday level. I need to see this level fail. I need to see sellers being confirmed active on the intraday timeframes in order for my macro timeframes to come into play, right? Just naturally, such that if 6730 fails, if 6690 fails, right, the prior day's low and the overnight prior day low fails, then we can finally get access into a minus 1.5% dip, a minus 2% dip. And that's where I'm going to be interested to purchase a high quality macro level of interest, right? So you can look at the prior day's low purely based on the structures and the ranges that you're trading as a high quality intraday low, but it certainly is not a high quality macro low. You want to see this level fail if you're a macro swing trader. But if you're an intraday trader, doesn't matter win or lose, this is an A plus intraday setup. So first of all, let's talk about the false breakdown. So let's get rid of this. Let's go into the 5-minute time frame. So firstly, the level is right here. The prior day's low is right here, 9:30 a.m. 67.0575 is the low. 67.0575. That's where the horizontal line comes from. Number one, the false breakdown predetermined entry model. You literally just have long waiting at the level, and you can have a fixed 10, 20 point stop loss. It really comes down to your risk tolerance. I would say for the intraday levels, you probably want to have a tighter stop loss so you can get that scale target. And then for the macro levels, you can have a wide stop loss as you're looking to swing that level anyways. So let's say, for example, you're right in the middle. You want a 13-point stop loss. In this situation, your 1R, unfortunately, does not get hit. 67.1875 is the 1R. The 1R, and that's 13 points above the entry in which it does not get hit. So in a situation like this, if you're doing a predetermined entry model, you're still active in this position and you're just waiting to see if 67.05 is going to continue to hold, if the current RTH low is going to continue to hold, if 66.9650 holds, in which you can get a move back into this resistance pocket, 67.19, and especially 67.3150, that's going to be obvious resistance now on first test. And that's going to be the area that buyers need to recover if the intraday trend is going to resume back to all-time high and 67.44. So that's the predetermined model. It's the most basic and it's the most simple entry model. So when we get a little bit more into it here, for the traders that are active behind their desk, I highly recommend to use the false breakdown or the Fibonacci trap entry model, and they both presented themselves. And it's really important to understand that because 67.3150 failed, you know that volatility has returned to the markets. If volatility returns to the markets, then you're gonna see instances where price action tags specific extremely important inflection points and literally bounce within a few seconds or a few minutes. Why? Because volume is high and volatility is high as sellers are now active, from an intraday perspective. However, when you see the false breakdown active here, literally just this wick is all you need to indicate or to tell yourself that you're interested in this level to go long. Then you can literally just mark it into the level itself, right? And you had a few opportunities to do so at 1:40 p.m. roughly. We can zoom in here to a 1-minute time frame and see it better, right? So as soon as you see price action reacting to the level, you know that there's demand in the level and you understand the significance of this level. You know that if buyers lose this level, then the intraday trend can conclude. So you're willing to take a bet here, right? Every single trade that you take is a bet. There's no guaranteed that you're going to make money. That's why I tell traders, you have to risk money that you're willing to lose on every single trade that you take, because every single trade that you take is a bet, period. Other than that, when you see that there's demand in the level and you mark it in, right? So here's the false breakdown model, mark it into the level. Then you can place your stop loss behind the established low, or you can do a 10-point fixed stop loss, right? That's what I like to do for my risk management as it pertains to the stop loss. You can put it behind the established low at 1:41 p.m., or you can do a 10-point fixed. So let's say you did a 10-point fixed, you market it in right here, zero point 0.4 ES contracts, so 4 MES contracts, and then your 1R gets hit right there. You scale out, and whatever happens next is completely up to the chart. You have no power over the chart. You only have power in your risk management. So that's why you're entering on the false breakdown. That's why your stop loss is fixed 10 points or fixed behind the low that's established. And from there, when you scale out, it's either the market is going to continue higher or it's going to reverse back into your stop loss. But because you scaled out, you're completely fine with whatever situation happens. If the latter happens and you get trailed out, you're not going to give up on the structures below. Or if we continue higher, then that's obviously the best case scenario. And you will hunt the next target, probably 67.30 would be your next target. And from there, you're holding on to a tiny runner for all-time high, right? So that is the market into the level false breakdown entry model. Now let's talk about the Fibonacci trap. First macro level you're looking to go long is 66.70. Yes, that is the first level that I am interested in to go long, 60.70 or 66.70. All right. So when we're looking for the Fibonacci trap, we're looking for the higher low, right? You want to see volatility, you want to see recovery, and you want to see the higher low. Take a look at this chart. Do you get all three pieces of criteria for the Fibonacci trap? Somebody in the chat, let me know. Do you guys see the Fibonacci trap without me having to draw the Fibonacci? I think it looks fairly clear, right? So when we have the established low, you already know that price is volatile, right? Because we wrote it down in the pre-market ES guide. 67.30 failing equals volatility. 67.30 failed at 1:20 p.m. with this outside bar holding below, right? So you know that volatility is active. That's criteria number one, checked, right? Check. And now you need to see recovery. So when you get the 1:40 p.m. candlestick to wick, it's showcasing demand and it's showcasing that it wants to trap sellers down here at the significant support level, the prior day's low. Then you're looking for the higher low. There's two higher lows now to play. There's the 1:45 p.m. higher low, and then there's the 2:20 p.m. higher low. There's even a higher low that's trying to be made right now at 2:55. But let's say, for example, you traded the 1:45 Fibonacci trap, right? So we're going back to the original thing that I said earlier. When volatility is high, price action is going to be quick. Fibonacci traps sometimes literally get printed within a few minutes. That's why we do so much work in the pre-market though, because our brain is already aligned with whatever price action can potentially do. We're flowing with price action like water in a river. I have everything marked down for both buyers and sellers. What do buyers want to do today? What do sellers want to do today? Where is my area of interest? What is the entry model that I'm going to look for in real time? And then I'm going to turn my brain off and execute the risk management. Whatever happens, happens. That's professional trading 101. We're ready to react, but we're not ready to predict. If the market were to continue higher and break out all-time high today, that's totally fine. If the market was to crash today, that's totally fine. Every single scenario that that price action wants to produce, we are prepared for. But obviously, we're not going to trade every single scenario that the chart wants to produce. That's the number one issue that retail traders have. They want to trade every single candlestick. They want to trade every single move, or they feel like they're missing out. That's FOMO 101. For us, we have an advantage, we have an edge, we have one setup, we have one system, and everything else is noise. Everything else is written down, so we are aligned with price action, and so we're ready to adapt when need be, and we're ready to execute without hesitation when need be. So the process in the pre-market takes precedent. If you don't have this process in the pre-market, you're not very likely to become pro, because the emotions of trading is going to be something that you will endlessly struggle with, right? The best traders in the world are just the ones that are just that much better at managing their emotions than the rest of the pack. But anyways, let's go back to the Fibonacci trap here. Let's go to the 1 minute time frame. So this Fibonacci trap produced itself, and I was actually watching this in real time. at 141, 142, 143, 144, 145. So you had 5 minutes here to draw up to draw up this Fibonacci trap, which in my opinion is more than enough time to do so. Why? Because you did the work in the pre-market already. You know that Monday's low is somewhere that you want to trade. You know that Monday's low is a must hold level, and you know that you're willing to bet here. So 5 minutes is more than enough time to draw up this Fibonacci trap. How does the execution look? Let's say at 143, 144, you put your limit order in. 67.0575, that's where you want to long. Again, it's the exact same idea as the original false breakdown entry model, which is marketing into the level. In this case, your stop loss can go behind the established low, or you can have a fixed 10-point stop loss. Let's say you use the fixed 10-point stop loss. It's the exact same thing as the original false breakdown. You're just using this higher low Fibonacci trap as a bonus confluence, especially if you're somebody that's a beginner, you're new to trading, you want that extra piece of confluence to practice, and you don't really have the best understanding of the contextual significance of the levels. So use the Fibonacci trap to showcase that there's that little piece of extra demand at the level that you're trying to buy. If you didn't get filled at 145 with the Fibonacci trap, it then presented itself one more time at 220, around 2:20 p.m. today, in which is the exact same thing, exact same entry, exact same stop loss, and exact same execution. Your 1R gets hit right there, literally half a tick off. But if you're obviously executing in real time, hopefully you got out a little bit below right there, in which this trade is still active. It's still active. The low of the day, 67.02, has not been broken. It tried to break down at 3 p.m. It bounced again. Let's see into the close what happens. Do we close above 67.02? Do we close below 67.02? That's going to mean a lot, right? That's going to mean a lot to what can happen throughout the rest of the day. So for me personally, guys, I shorted today because I wanted to hedge my portfolio. I used futures as leverage on my portfolio essentially, and I wanted to be short in case the market produced what it produced today, which is just traditional stop hunting after a trend day. Just very traditional stuff, right? The more time you spend studying ES, things like this are very traditional, but we had a little bit of an extra bonus edge with Powell on the mic. And I think Powell on the mic definitely created some volatility in order for 67.30 to fail. I'm waiting for 66.70.25. That's my macro level of interest. 66.70.25. That's where I want to long. So we'll see if we can get there at the close. We'll see if we'll get there tomorrow. Other than that, when 66.70.25 gets filled, the bots will let us know. I'm going to be buying the level, and we'll see if we can get the false breakdown from there. Did you share in the chat when you shorted? When you shorted, no, that trade was not a traditional trade. That's not a traditional setup that we have in the Discord. It's a hedge, and I purely did it from a personal perspective because I needed a hedge for my portfolio. If you didn't need a hedge for your portfolio, then the short today is just one of those shorts that you take at all-time high if you want to short all-time high. But as you guys know, we don't really mess around with all-time high in the Discord. So my short today is purely based on my portfolio goals. That's pretty much it. I needed a hedge. And I'll post it right here so you guys can see my broker. So a little bit, I invested $200 into the hedge, and I'm currently at, let's see here. Currently at about a little bit more than 2R. But I'm obviously going to be holding this as well. I'm obviously going to be swinging this position. Yeah, and this was my first ever short since the last time I hedged. The last time I shorted was the last time I hedged. And I think that was the last FOMC event before the one that we had recently. I have to look back at the calendar to see that. But anyways, guys, if you have any more questions, comments, concerns, you can let me know. Today was all about the market's context and the market's analysis. The market's analysis was spot on. It was high quality. It was A+ for today. I made sure to warn everybody that if 67.3150 failed, we would start to liquidate. And it's absolutely no surprise that below 67.3150, sellers took the elevator trip down the range, right? Look at the size of these two 15-minute candlesticks from 1:15 p.m. and 1:30 p.m. versus the entire morning, right? It's very, very obvious that liquidation did indeed occur below 67.3150. That's what we were very prepared for if it were to happen. I even wrote it right here: liquidation below 67.3150, which is the previous all-time high, is possible. This level failing triggers trapped range high buyers for a move into the prior day's low, and that's exactly what happened today. We're not going to be doing the book club. I really want you guys to soak in the information that I presented today. And it doesn't matter if you traded today. It doesn't matter if you took the false breakdown, if you shorted all-time high. I really and truly believe that understanding the internal and external market context takes precedence, and the process takes precedent as well. If you cannot have that process in the pre-markets, then you're probably not going to execute high quality trades anyways, and you're probably just going to succumb to revenge trading, over trading, boredom trading, things like that, and gambling, because that's what the market wants you to do, and it's going to do everything in its power for you to do that. That's why the process is so key, to keep us in check and to make sure that we flow with price action like water in a river. Every day I tell you guys, the structures are going to dictate who's trapped and who's in control on which time frame. The structure at 67.3150, these arrows right here, showcased trapped buyers at the range high for liquidation. Bought 3 MES contracts at 67.05, stop loss 66.95, sold one at 67.15, then moved, stopped the break even, 702, and the other two waiting on 66.70. Now appreciate the streams. Yeah, that's perfect execution right there. Absolutely perfect execution. Absolutely perfect execution. But I think 66.70 is definitely that level that I'm going to be waiting for. I think majority of macro traders are going to be looking for. Institutions are probably going to be looking for. It's a minus 1.5% dip, something like that. So the prior day's low, it is a quality trade. But as I say in the live streams a lot, if you lose at the prior day's low, doesn't matter. A plus and A minus, A plus setups, they can fail. If it does fail, are you going to give up on the levels below? Obviously not. 66.70 is my next high quality low of interest. And we talked about yesterday in the after hours homework report that the line in the sand moved up, right? The line in the sand moved up. And we talked about it in the pre-market live stream today that 67.30 is now the line in the sand. What I mean by line in the sand is bullish time frame alignment concludes below it. The intraday trend maybe concludes below it as well. So when this line in the sand fails, we have to adapt, we have to be cautious, and we have to be prepared and ready to execute the high quality lows of interest. We only need about 30 points for 66.70.25. If it gets filled overnight, it is what it is. I'm not sacrificing my sleep over the game. If it gets filled overnight, you can definitely have an order waiting overnight. For me personally, I won't have an order waiting overnight. Maybe I will. I'll let you guys know in the after hours homework reports. And then we have 66.11, which is another massive high quality low of interest if we get there anytime this week. I appreciate you guys so much. You guys are awesome. I hope everybody had a fantastic day, and I hope you learned a thing or two about the market context and structures, as it is the most significant thing about our technical analysis. Thank you guys so much for listening, and the stream recording will be posted if you want to rewatch. And I will be back tomorrow. Let's see where price action opens tomorrow. I think the overnight range is going to be very, very key. Thank you so much for listening. Avoid the scammers. If you need a one-on-one with me, please reach out to tradingwars.com or email Rich at tradingwars.com. You guys know where to contact Rich. Appreciate you guys so much, and I'll see you next time. Enjoy the rest of the day.